Hey everyone, hopefully you're having a great day. My name's Andy, my channel's Finding Value. If you like making some money, if you like maybe doing a little bit further research before you start investing in some of your investments, I can put a bunch of really good investment opportunities in front of you that are undervalued. If that sounds interesting to you, click subscribe, please. I'm going to go over some market information. These are what drive markets. And when you understand what drives markets, the investments and prices will come. Your money will come. Your investments will work with time. So let's look at the market data and market information. And I'm going to try to explain some of these charts and what they mean. So here's some market information, and I'm going to give you what my opinion is on it. So let's look at a whole bunch of information about the market to see what's overvalued and what is undervalued. And I'm going to be talking a lot about a whole bunch of different things here. So the real interest rate, which is the blue line here. The red line's inflation. The black line is the interest rate that we know as the Fed controls. And then the blue line is, quote, the real interest rate. So whenever this blue line is going down and is negative. So when it's coming back down and the rate of change is pretty good, going into negative territory like this, gold usually does very well. And when it goes up, gold doesn't do as well. So really what you want is a twofold thing here. You want a decline in real negative rates. It's going down or becoming more negative. And the steepness of the line matters. Whenever this thing pops higher, it's going to have an impact on gold prices and on commodities and the dollar eventually. Well, not really the dollar. I'm going to say on gold prices. So real interest rates, this is looking at a longer term perspective. This was the last bull market back here for gold, a very large bull market. Then we have another large bull market from I'd say about 2000 to 2008. You want this to come down, and that's when prices really start to move, or when they go sideways in a negative. So this would have been a good time to be in gold when they came down. Now we are creating that same, we'll call it negative real rates coming down. So it is occurring now. We just haven't really we've seen the price kind of jolt higher, and then it's gone sideways. But the conditions are laid down for higher gold and silver prices and for higher commodity prices. Now, what I'm going to do is I'm going to show you kind of short-term yields and gold price and correlate those two together. So on the left-hand side, these are yields over here, and this is gold price. And notice when yields bottomed in August of 2020 and they started to head higher, that's when gold started to lag. And even, it's starting to come back and pull back a little bit as this leads a little bit higher in terms of yields. This is the 10-year yield over here. This is gold price on the right. And I just was looking at the charts. August was definitely the bottom, and August was definitely the top for gold. Higher yields, lower or sideways gold price. So a difficult thing to project here is real interest rates are based off of two things. It's based off of inflation and then the interest rate. It's dynamic. They change against each other. And we're looking at that difference between inflation, the red line and the black line. And that the bigger that is, the more negative we go. Here is only looking at it one-dimensionally. This is just yields. We're not looking at that compared to inflation. So it's not 100% correlation. I just noticed that this correlation of August and August correlates up in yields, down in here, and some people get this confused. So perhaps the market thinks that we have rates that are getting less negative, and maybe they're wrong. Maybe they're wrong. Maybe they have to see the inflation before believing a CPI number or whatever it may be. But I just wanted to show that correlation. Here's the Dow to gold ratio. One thing I was looking, I went all the way back to 1930 on this. I charted it out. Perhaps we go all the way up here Maybe we have like a melt up boom. Now, in Weimar, Germany, and some of these high inflation conditions, and I'm not saying we're going to go into hyperinflation. I'm just saying in a high inflation condition, sometimes stocks pull up quite largely before the big move in commodities. Perhaps that's what we're doing. Maybe we'll head back up a little higher before we turn back down. Maybe not. I mean, I don't have a crystal ball here. I'm just showing you history of the Dow to gold ratio, and that we are at a very high point, because 20 is right here. 20 is basically right where we were in the 1929 peak of their bubble stock market. We went a little bit higher here, and we went a little bit even higher here, but we're coming up on 20, and that's a pretty bubbly Dow to gold ratio for the Dow. Stocks to real estate ratio. Stocks are super expensive in relationship to home prices, and they're right at its long-term trend line. I'm curious to see if this thing hits its head and heads back down. Now, if the S&P 500 hits its head, the Dow most likely, and I think this will most likely turn over. So I wanted to share this, just showing you how expensive the S&P 500 is in relationship to home prices. And it's more expensive than it was in 1999. Pretty incredible. Real estate to gold ratio. And as weird as this is, real estate is actually not too expensive in relationship to gold. It's kind of almost under fair value. Kind of weird, I know. Cheap up here, like 2001, that's cheap gold. But down here is cheap real estate in relationship to gold. And I think gold is cheap in relationship to stocks. I think gold's cheap in relationship to the monetary system, or money supply, I should say. So real estate, you could argue, is cheap in relationship to gold. So, I mean, that's kind of funky, because in 1980, I mean, if you look, we're not too far off of the 1980 bottom, 2011. And then, I mean, real estate's not too bad. Copper to gold ratio. This thing is declining. Here's 71. I think we're going to come up and tag this line again at some point. I don't know when. It's probably going to take some years. It took a good 25 years to do it here. I think we're at a bottom, and we could be similar like the 1940s. We could be. And I think this is going to come back up higher. Why do I think that? Inflation and the difficulty of getting copper out of the ground. The ore grades are declining quite rapidly. I also think gold is too, though. This is a funky number because gold's going up and copper's going up. Oil to gold ratio here. We are way down here in 2020, below everything. Absolutely super cheap down here. And we're still in a very, very cheap area down here, looking at the oil to gold ratio. So oil is a fantastic value all the way back to the 1940s. This is U.S. debt to GDP. We are going vertical. This is getting into ridiculous areas. So that's something that's not good. Stocks to commodities ratio. You know how I like using that. We are way up. We are in a, quote, deflation in relationship of commodities in relationship to stocks. So it is deflating. And I think this is going to turn and be an inflation area. So it's deflation here, inflation, deflation, inflation, so to speak. I think this is going to head back down at some point. Gold to silver ratio. We're way up here. 2020 was a kind of a very long-term high, and I think it will continue to move down to more of a normal, below 50 probably, ratio. So I wanted to just kind of go over all this, so hit up some of the ratios and valuations. I still believe that commodities are a good spot to be. I think they're good because of inflation. If we lose the inflation component, I think only a certain few may be tolerant of that. I don't think we can have deflation. So there's a lot of people with this deflation thing that they think deflation is going to come. The system fights deflation, if I can even say that word, for a very long time. It will always fight it. So what they do is they print to kind of force inflation into the system. They can't survive in a deflationary, a long-term deflation. You would bankrupt yourself almost. Like your tax base would go down and down and down. So I think they're going to have inflation. They've got a lot of debt, and I think they're going to have to spend. And if they lose their tax base, that's when you have to worry. America. If they lose their tax base and their tax revenues go down and all they do is finance everything through money printing, that's going to get very inflationary. And I think that's what we're doing. So I'm looking for inflation. I think we have inflation. The bond market agrees with me. The dollar going down agrees with me. So at the time, it's all in agreement for higher commodity prices at some point. If you guys like this content, give me a thumbs up. Let me know what you think in the comment section. And thank you for listening. This is Finding Value.